You should have invited the right people.
I know. I'm like, man.
Note I didn't start recording until after we were done with that conversation.
And then he went flying here.
Alright, so moving on into chapter 15, we will start talking about long-term loans instead of quote-unquote short-term loans. And what is the standard obvious example for a long-term, longer than 10-year loan? Normally these loans are going to be mortgages, folks. Alright, so before we start diving into calculating, playing around with money, and monthly payments, and all the other kind of stuff, just to give you a little background on purchasing houses, right, and the types of things that you can do when you are trying to get a house or get a mortgage, basically getting a loan, right? So, some of the different types of mortgages, the standard example that most of us are probably playing with in this current economy is a fixed rate mortgage, right? Where we basically say, look, we're going to pay 3% interest or 5% interest or 8% interest monthly on our loan for however many years we decide to finance it, all right? And there's been a push to allow for longer mortgages for certain people. There have been a couple of banks in the area that have been allowing 35 and 40-year mortgages. Generally speaking, most banks won't go that high unless there are special extenuating circumstances. Like you are extremely young and you have a steady job at this stage already, right? So more times than not, though, most banks, they're going to limit you at the upper end of 30. And it's mostly because when we go to buy our home, we're already so damn old that by the time we pay off a 30-year loan, if we're 65 or something when that happens, what do you normally do at 65? Hopefully you retire, right? And hopefully at that stage you own your house. Yes or no, right? Right, so monthly. Get the L, monthly. Fixed monthly percent of owed a month. That's the standard loan that's out there. Now, you can also get what's known as an ARM, or an adjustable rate mortgage. These adjustable rate mortgage. The only difference between an ARM and a fixed is that, well, the fixed is fixed, and
the same.
And the adjustable is
changes all the time.
Yeah, all right. Changes in percent based on
The market.
quote unquote market. All right. Now the market is generally measured by some Federal Reserve rate. Mostly they generally they tend to mark it off as a percentage of the prime rate. Prime rate is what the banks charge to their best customers. And generally when you're getting a mortgage, you are not considered one of the best customers. So it usually is the prime rate plus a certain number, right? That's what the adjustable rate works as. Now the nice thing about adjustable rates is that what you can generally do is get a lower interest rate at the beginning of your mortgage, and then after a certain amount of time, it will move into this adjustable rate where, based on the prime rate, it may start off as being like a 2% loan for 5 years, and then after 5 years, it'll become 6 or 7 or 8% for the rest of the loan. And again, that will vary as the Fed changes interest rates. The other thing that you can do is something called buying points. So I don't know if you guys have ever heard this phrase, but the way it works with points, right? Buy a lower percentage. what you can do is buy a percentage point, all right? What that means is that suppose your fixed rate was going to be quoted to you at 6%. You could say that, well, you know, the bank will say, you can, if you want, change this to a 5% rate as long as you pay a point of interest. A point basically means that you pay an additional percentage of the actual mortgage on top of it at the beginning of the mortgage, right? Basically, it balloons your down payment, right?
Too much.
Yeah, so usually this 1 point equals 1% of your mortgage up front. So if you buy a point off of your interest rate, what you're basically doing is saying, look, I will give you $12, $15, some $1,000 in order to lower my interest rate for the first X number of days or X number of years, right? And what a lot of banks do is when you buy this point, instead of forcing you to put the money up front, they'll actually write you a secondary loan for those points. And they will give you a quote-unquote second mortgage to start your mortgage with.
Oh, nice of them.
Yeah, banks are... Yeah. Again, they're trying to make it so that you have a lower interest rate on your overall mortgage, but at the same time, they're trying to
make money.
Yeah, make money. Right. And it's a push, generally speaking, when you buy points, folks, as to whether it's worth it or not. I mean, the banks know how to make it so that they're still going to make money and you're still going to have to pay it. So, buying points, it's one of those things that I tell people, the only time you do that is when you have the extra money up front to buy the point initially, right?
And if you have the money, just put it towards your down payment. That'll lower itself. Why would you buy points?
Again, I agree with you. That's generally what I would tell people to do, but again, there are some times where purchasing points is advantageous for you. A lot of times what it comes down to is how long you think you're going to stay in the house. So you could buy a point for 4 or 5 years, and if you know after your 4 or 5 years you're going to move out and sell the house, it might be to your advantage if the value of your house increasing is going to be somewhere around 1 or 2% per year. If it's less than that, it actually is to your advantage to do this. Again, if you can see into the future and know how much the value of your house is going to increase, you could play this kind of game. And lots of people do who think that they know what the value of a house is going to do over time. I cannot pretend to know how that's going to happen. Again, maybe if you're in real estate and you've been around the business for a long period of time, you can figure these sorts of things out. Honestly, I don't know, and I don't trust realtors enough to actually be willing to believe them when they tell me this sort of thing, right? Now, when you buy a house, normally, in order to purchase the house, you will potentially have to buy PMI. You guys ever heard of PMI? Yeah, it is. Basically what happens, if you don't have 20% down, you must pay PMI. Basically that's mortgage insurance. It's personal mortgage insurance. That's what PMI stands for. Personal mortgage insurance. And the reason that this is now a standard in the business, of course, is the crash in 2008, 2009. There were lots of people who didn't own at least 20% of their house, and the banks took a serious wash on their bottom line when they foreclosed on you. Well, it was the bank's own fault because they were playing around in markets that were extremely scary. But in order to alleviate that particular problem, basically the government said that you guys either need to guarantee that you have 20% of every asset in cash on hand, or you have to have an insurance clause for every dollar that you don't have in 20% of loans that you're making. Right? So realize that banks have hundreds of thousands of loans going out there, from $50,000 to as high as potentially $1 million, right? Multiply those numbers by thousands, and you realize how much debt the bank is owed. In theory, the bank has to have a certain amount of debt to equity, right? They have to have a certain amount of cash, value assets in hand to be 20% of how much people owe them, right? And that's a way of saying that, okay, all of this money that people owe us, which they think they're going to get, but can't guarantee, they got to have some way of validating that they put on their books that their company is worth that much money, right? So they say, we've got $150 million in loans. They put on their monthly statement saying, we're worth $150 million. But, and that assumes that all those people who they're lending money to are going to pay them, which unfortunately is not a guarantee. All right? So this is what people talk about when they talk about debt to equity ratio. It's not necessarily debt, it's future earnings. Think of it in that terms for this bank. And they got to have at least enough money to validate that this future earnings are really possible. And so the 20% is a standard number. So what happens though is that if you don't put 20% down, you will have to pay mortgage insurance until you get to 20%, right? This PMI can be removed when mortgage holder owns 20% of the value of house. Right, and it's not 20% of the mortgage, it's 20% of the assessed value of the property that you own. Okay? So what a lot of people did initially when they came up with this is that they thought the 20% was based off of their mortgage, but it's not. It's based off of the value of your assets. All right? So if the value of your property actually goes down, that 20% now becomes a lower number, and as long as you have that much in equity built up into your house, you can remove this PMI. This is what a couple of friends of mine who were still paying personal mortgage insurance, they didn't know that they could go into the bank and say, look, hey, recalculate our 20% and see if we don't need to pay this anymore. And even though they hadn't reached 20% of the mortgage, they actually could get rid of the insurance because now at least they own 20% of their house. Granted, they owed, they were underwater. They owed more money than the house was worth, and that's another term that you guys should know is underwater. Underwater mortgages means that you owe more money on your house than it's actually worth. And again, back in 2008, 2009, that happened to a lot of people, where the amount that they owed in their house, $50,000 or $60,000, and the value of their house all of a sudden dropped to $40,000. If you owe $60,000 for something that's only worth $40,000,
you let it foreclose.
Yeah, let it foreclose. Get the hell out of Dodge, right? I mean, that's to your advantage to do that. But again, the issue with it that a lot of people, or what a lot of banks tried to say, and it wasn't a bad argument, was to tell people, hey, look, your $40,000 house, what's it going to do in the next 4 or 5 years? Hopefully, it's going to recover some of its value, right? If things turn around, the economy turns around, your $40,000 house is going back to being a $60,000 house. If you keep making your payments, eventually the value of the house will be worth more than your mortgage and you'll be back in water as opposed to under it. Again, that's knock on some wood, okay?
Right.
But again, a lot of people seem to forget that when you're buying a house, you are gambling, right? You're buying a house hoping that the value of the house at least stays the same. And really you're hoping that it goes up. And it had been for 45 to 50 straight years. Unfortunately, crash. Alright? So, anyways, realize that these are things that you have to pay for when you're dealing with a home mortgage. What else do you have to pay when you buy a house?
Insurance.
Please don't forget that you need regular homeowners insurance. When we first bought my house, I think our homeowners insurance was like $140 a year. It's now up to $700 a year. Yeah, when we first bought it, it was $140 a year, $70 every half year.
Yeah.
That was
That's
great.
nice.
Yeah, it was nice, right? And then, of course, then all the crap happened with the crash, and insurance companies took as much of it as banks did, folks, right? In fact, the insurance companies took
More.
bigger, yeah. And so they had to start recouping funds, and that's how they did it. Was they took your homeowner's insurance and quintupled it, right? Multiplied it by 5, basically. So, what else you got to pay? Yeah, don't forget your property taxes. Please remember that the first year that you own a house, if you buy a house mid-year, you split the property taxes with the old homeowner and your homeowner. So if you buy in, May, you pay 7/12 of it, and they pay 5/12 of it, and the city will do that for you to make sure that they pay it. They'll actually force this person who's selling the house to escrow that money immediately once they sell it, right? They'll take some of the money out of the sale and put it into an escrow account that will then pay the city property tax when it comes along. Pretty standard. What else? What else is there? Closing costs, right. Closing costs are very, very, very versatile, folks. It depends on the type of bank you're buying from, right? Some banks will tell you, oh, it's 0 closing costs. But what usually comes along with the closing costs? One of the things that you must do is transfer the title from the old owner to the new owner. And one of the things that the closing cost does is that it checks the title for any loans against it.
Yeah.
And that's extremely important. If you transfer a title from one person to another, and there's a loan that's based on that home or that property,
You take that loan.
you assume that loan when you buy the house.
Yeah.
You very, very, very much so want the title company to do the insurance check, to do the lien checks, to make sure that you're not buying a little bit more than the house. Because there's a lot of people, when they buy a house, if it needs updates, what do to do it, right? Borrow on the house, right? They'll say, it needs a new furnace. Yeah, I've got a separate loan with the furnace company that's based off of the property value, etc., etc. Again, you want to make sure that those things are on there. Built into those closing costs, title transfer. The assessment of the value of your property. Again, you do usually have to do that. Most banks will force you to do an assessment unless you have had an official assessment done within 12 months. If you've done one within 12 months, they will use that as the assessed value, but they will not use the assessed value from the tax man, okay? Those are technically different people, right? So if you say, well, can't you just say the assessed value is whatever the taxable income is? They'll say, no, reassess. Again, that tends to be a standard fixture in there. There are, folks, there are generic taxes built into all of that as well, sales taxes and all the other kind of business. Right, so a lot of banks will not include the taxes on a sale in the closing costs. Others will. Basically, it's again them trying to be shystery, right? There's no closing costs. Oh, but by the way, you're going to owe $800 in taxes. But those are taxes. They're not closing costs.
Right.
You may or may not have to pay buyer or seller agent fees. Usually when you're selling the house, you have to pay the buyer and the seller fees. Usually when you're buying the house, you don't have to. It's assumed that the seller will make that 2.5% to 3% payment to both of the buyer and the seller agent. Right? So when realtors get together and figure out what the price of this house should be between each other, they get a cut, right? It varies from realtor to realtor. Some of them are as low as 2%, some of them are as high as 3%. Again, that's the sort of thing you should ask your realtor before you start using what their fee is. Let's see. What else is built inside of here? Okay, yeah. Just make sure that the seller pays this, right? I think that's probably pretty close to all the different things that come into play. Again, one of the other things that you should always do when you buy a house is make sure that you have the inspector go through the house and determine all the different flaws and problems with the house. So that when it comes time for you to discuss the price, you can say, well, you know, I had the inspector go up on the roof is 15 years old, the tiles are 15-year tiles, really needs a new roof, etc. Alright, so just some good for you mortgage information stuff. We will come back on Wednesday and learn about the calculations in dealing with a mortgage and how much interest you pay on a 30-year mortgage. And yes, it will make you want to vomit, but it's part of the game. I'm sure it is too.